And now to my conversation with Dean LeBaron. Well, it's great to welcome Dean LeBaron to Business at Night. How are you, Dean?
Just fine, John. Thank you very much. Ni hao.
Ni hao.
Talking about China, you will use that greeting.
Dean, I'd like to start with the milestone decision announced by the IMF's Managing Director, Christine Lagarde, on November 30th, 2015. Now, although it doesn't take effect until next October, what is the significance of the Chinese yuan's inclusion in the SDR basket with an initial weighting of 10.92%?
Well, the IMF is recognizing the inevitable, and that is that China is either the first or second largest economy in the world, and to be other than approximately equal to the U.S. was a slap. Now, further, the IMF was brought to this by the development of the Chinese for its own World Bank roughly 6 months ago. And you may remember the Chinese said they were going to have the equivalent of a World Bank for Southeast Asia, for Asia. And it turned out to be very much like the World Bank. It had a proud 80 members, almost all of except the United States. It was very much against it because they were cutting into the activity of the World Bank. Finally, the U.S. came in, and I think they got a couple percent, whatnot. But IMF had no choice but to put China in as a big way because it has decided to be a big player in the international banking business, and they will be. Furthermore, you will remember that our President Obama, and it's important to remember that he is the United States president, mentioned that about 3 or 4 years ago, this century would be the Chinese century, it'd be the Asian century, and the U.S. was going to tilt toward Asia. It's sort of forgotten now as we have very much tilted towards where the action is, the Middle East, but it's still the Asian century. Just one more point while I'm at it. I was one of the first people to go to China from the West, way back when in the late 70s, early 80s, in the so-called Lindblad tour. And I noticed several things then, and they're bearing truth. The Chinese are brand name people. They understand brand names. When they first started wearing sunglasses, they left the brand name on the sunglasses so you couldn't see through it. But it told people that they were right up with the latest brands. Furthermore, they would buy Western watches, Rolex watches and like. However, there was nothing inside them. There was no works. But they would wear the watch so you knew, and they still are that way. They are brand name people. Final comment to why Christine Lagarde recognized them is that they treat corruption very seriously. They shoot people for corruption. They don't fuss around. One guy who was the 8th wealthiest guy in China just died of a so-called heart attack yesterday. And no one in China believes he had a heart attack. Corruption is treated extremely tough. So they're playing the long game, the clean game, with lots of money. They own more currencies from everybody else than anyone else in the world. So yeah, it's the Asian century coming up. Now they'll put some mechanism inside their watch, but their watches operate at a slower rate than ours do.
Well, that's fascinating. I'm a history junkie, as you know, and look at long cycles. And of course, the 1800s were the era of the pound sterling, and the 1900s, the US dollar. And as you say, now we're heading into a yuan-dominated currency world, I expect.
I think they'll play it soft. Looking at the nature of the world, there may be one important economy, it may be a banking economy, which we claim is China, because they have all the money. But I think they're not going to be terribly tough in dominating the world. I mean, they will have the Pacific Trade Organization reform, and it will be a light management, but it'll be carefully supervised by the Chinese. We used to joke about the fact that you'd have a Swiss accountant. In the future, we will not joke when we say we have a Chinese accountant, because the Chinese accountant may have it 45 in his dress.
Well, I stand corrected. You're right. They'll play it with a silk glove.
No.
Now, gold and other markets have been manipulated in recent years by coordinated efforts by governments and bankers, and there are rumors that China may have accumulated 10 times the consensus amount of gold as an eventual backing to their currency. On the other hand, the paper-physical ratio may be upwards of 300 to 1, and that's to be confirmed. That's absolutely staggering. If that is true, what are the ramifications for the musical chairs mismatch?
Oh, they are huge. And I'm a fan of transparency, John, as you know, for our lifetime friendship. I believe in having all the secrets out in the open. I still say I don't know anybody who has been inside Fort Knox in the last 40 years and admits it. It's about as secret a place as Gitmo. There may be some other comparisons with it, with Gitmo as well. But the same thing is true with China. But I think China will, at some point, maybe when its participation in the SDR comes out, they may open the door and say, here's what our gold is. And for the first time in some while, we actually see what the gold holdings really are. Gold is manipulated currency, and you just got to sort of sit back and say, I don't know what's going on now, and just sort of not sweat it out. But a year from now, gold will be the currency that meets the requirement of Bill Gross, who just said a few days ago, in 2016, we should not worry about return on investment, but return of investment. And gold is a good candidate for meeting Bill Gross's requirement.
Well, I wish I was going to be around to see the final act of this incredible currency show. But in any event, you and I may be in economic underworld with Nikolai Kondratyev watching that final act.
Well, let's arrange for a joint seance to both of us at the same time by a neo Nikolai Kondratyev, and who would reach us both in the economic underworld. I would do it.
And we'll connect with our grandchildren by Skype.
Yeah, that's correct. Absolutely.
That's a deal. Dean, it's always a pleasure.
John, very much so. And Sheshe.
Sheshe.
My friend Larry Gettolo of the Institutional Strategist in Minneapolis publishes the Market Intelligence Report from all over the world, and he offers his sage thoughts on markets. Today, he observed that some measures of junk bond yields are hitting 2009 levels. Bank holdings of both junk and investment-grade bonds are plunging as the Federal Reserve's 22 bond dealers sell off inventory due to tough post-financial crisis regulations. How are these dealers getting rid of their inventory in a traditionally illiquid market? Why? They are selling them off to retail investors, of course. Online bond trading volumes are hitting record highs just as debt issuance is spiking. Around $8.6 trillion U.S. of corporate bonds have been issued in the past 5 years. Now, online trading of these securities has risen from 8% overall volume in 2013 to over 20% of the market this year. If banks have traditionally been the market makers of these securities and they are now not interested or able to hold these bonds due to regulation, what does that imply for trading when a shock to the system, i.e. a flash crash, hits and sell orders start piling up? In addition, can the destruction of the commodities complex cause contagion for the whole market? This seemed to be an obvious question when it came to the financial sector due to leverage, but does it apply to other sectors? Larry thinks so. The U.S.'s key trading partners are Canada and Mexico and are both commodity marketplaces. Those are a couple of ominous reasons to assess the risk in one's portfolio. And as always, I suggest that listeners talk to a qualified and seasoned investment advisor, particularly when there are storm clouds on the horizon. Now, earlier this week, Stephen Poloz, the governor of the Bank of Canada, conceded that the benchmark interest rate could be cut to below 0% in the event that Canada faced a major economic crisis, if the nation really needed the stimulus. The fact that this contingency is being considered by the Bank of Canada is unnerving. Now, Mr. Poloz did state in his speech on Tuesday at the Empire Club in Toronto that he expects the Canadian economy to grow in 2016 and reach full capacity by mid-2017. Currently, the Bank of Canada's trend-setting rate is at 0.5 percentage point. That's 50 basis points. And Mr. Poloz said that if the Bank of Canada was required to take interest rates into negative territory, they would not go below minus half a percentage point. This seems absolutely incredible, given that the Bank of Canada's rate was 21.03% in August of 1981, and some of our listeners will remember that. How times have changed. Sweden is the first country to embark on negative interest rates, and it's a cashless society. And in fact, I think they'll call the police. That is, the banks in Sweden will call the police if you are not spending all your money. So this is a brave new world, and I can't figure out what's going on, and it's very challenging. A good chart depicting the price movements of a stock is often worth 1,000 words. And this morning, I received a scary chart from markets analyst Mark Ungewitter in Concord, New Hampshire. It shows that the price pattern of Europe's fourth largest bank, Deutsche Bank, with nearly $2 trillion in assets and $55 trillion in notional derivatives, has broken long-term support in dollar terms, and it's poised to follow suit in euros. We have to pay attention to this situation because a breakdown in the value of Deutsche Bank shares might imply a global derivatives blow-up, perhaps commodities related. This is conjecture, of course, but not an uneducated variety. We used to say that in a case of a derivatives accident, step on J.P. Morgan first and ask questions later. Now, derivatives are massive leveraged bets between investment banking counterparties on commodities and financial instruments with an estimated notional value of $1 quadrillion. Deutsche Bank now matches J.P. Morgan in notional derivatives exposure. Perhaps the new mantra should be reduce risk everywhere upon technical breakdown of Deutsche Bank common shares. My wise friend Dean LeBaron responds from Casey Key in Florida. Good conjecture, Mark, and it might be what is wrong with gold. Too many derivatives and a motive to get rid of them at any cost. To us oldsters, we used to think that base prices set derivatives prices, but not so now. Derivatives set the base price for almost everything. A super scary thought. 2008 again, global and much worse. It's time to be very cautious.
Well, thank you for joining us this evening on Business at Night. I'm John Budden, wishing you a great weekend. Enjoy the warm temperatures and have fun. Coming up, the incredible John Council. You have been listening to 580 CFRA.